Welcome everyone. This is day 6 of our month-long options for your ISA event. Today I've got Phil Kent, the manager of GCP Infrastructure. GCP Infrastructure is a FTSE 250 investment company, and I'm sure many people attending today will be aware it has a yield of over 9% and a discount of 26%, something that all seasoned investment trust investors will be very interested to look at. Phil will give you a brief presentation which will hopefully convince you that that discount is unjustified. And once he's done that, there'll be time for questions and answers. I'm sure many of you have attended more than one of these already, but just very briefly, there's a Q&A box in the bottom right-hand corner where you can type your questions. I'll be reading those whilst Phil's presenting. No other participants can see those questions, so don't be shy. If you have any technical issues, also just put a message in that Q&A box, and one of my colleagues will try to help you. Presentation is being recorded, and the slides will also be available later for download. So if you miss something first time round, there will be another chance to look at it. And with that, I'll hand over to Phil.
Great, thanks, Alan. Hopefully everyone can hear me, and thank you for the opportunity to speak today, and indeed for joining. As Alan said, my name is Philip Kent. I'm the Chief Executive at Gravis. I've been the lead fund manager on GCP Infrastructure for the last 7 years or so. Perhaps before we go into GCP, I wanted to just touch on Gravis. Gravis is a specialist asset manager in the infrastructure and real asset sector. We have around £2 billion of assets under management across both direct investment strategies, the flagship of which is GCP that we'll be talking about today, but we also have a series of open-ended strategies that focus on giving investors access to a basket of listed securities within the thematics we specialize in. We have a 15-year track record. I'll go into that track record in more detail in the context of GCP Infrastructure, but I think it's our biggest asset and something we're extremely proud of in terms of looking back over the last 15 years and how we've performed. We're owned, majority owned by Oryx Corporation, which is a large Japanese conglomerate. It has asset management businesses, including Robeco, a large structured finance business in the US, as well as many other asset classes across the world. It's a heavy investor in infrastructure and renewables as well. So there's lots of complementary parts of our business to our owners, and they are hugely supportive of us at Gravis. That's enough about us. So to dive into, I think I wanted to perhaps touch on first infrastructure and what we mean when we talk about infrastructure. Very often our discussions with investors are focused on infrastructure as a definition of risk rather than perhaps a specific asset class like solar or wind or toll roads. The risk characteristics of what we invest in is really important. And I think that's particularly true today. GCP Infrastructure is a credit strategy, and we're very aware of the news over the last month or so has been very focused on private credit. And I wanted to upfront highlight the differences between perhaps private credit, which is elsewhere very focused on direct lending or replacing commercial banks in terms of lending to businesses where they're taking corporate risk, typically in shorter dated debt structures that rely on business performance or capital events such as a refinance or a sale to repay that debt, versus infrastructure debt. So first, what do we mean by infrastructure? This slide, I think, sets out the 5 characteristics of that risk profile. Infrastructure delivers essential services supported by the intrinsic value of real physical assets performing those services over a long time frame. So there's longevity to the asset class, and the cash flows generated by an infrastructure asset are underpinned by critical services or goods. All of the assets have high barriers of entry. The fact that there's a large upfront capital investment, but also if we think about this country in the planning process or the environmental hurdles that you have to go through before you actually get something built, does mean that the risk of substitution of those long-term services or goods is pretty low. Large amounts of capex, high barriers of entry to get a project developed and built means that there's an intrinsic value to the uniqueness of the services that an asset might provide. The fact that infrastructure has high upfront capital costs means it's very income generative. What I think characterizes infrastructure as distinct from perhaps real estate or some of those other asset classes in the direct lending space more broadly is the fact that there's really no residual value to the assets. So if we're thinking about an infrastructure project, it's an asset that generates a cash flow over its life with no residual value really at the end of the life. So when we're looking at lending into infrastructure assets, we're looking at the cash flows generated over a defined life. We have to fully amortize the debt over that life and receive the return. There's no assumption of residual value or bullet repayment at the end of an asset life. Typically, and there's a recognition in long dated projects that cash flows should adjust to compensate for higher operating costs or indeed change into finance costs that might be linked to rates or inflation. So the revenues supporting infrastructure projects tend to be inflation linked. And that provides a natural hedge, as we've seen come through recently during a period of higher rates, that provides some protection against the relative attractiveness of this asset class versus others. And I think the final point on this slide, which I think is another acronym that's been introduced quite recently into this sector, so hard assets, limited obsolescence, I think tries to differentiate infrastructure from perhaps other businesses, software businesses that have been quite heavily impacted by macro trends around concerns of the impacts of something like AI. It's very hard to see how trends elsewhere will impact the need or the criticality of real assets that have limited obsolescence risk in terms of reliance on technology that could be substituted by evolution of technology. So increasingly we're seeing, and I think we've seen this with the rally that's happened in utilities over the last 12 months or so, a real value on critical hard assets, which are not technology dependent necessarily. So to move on to GCP infrastructure specifically, I wanted to highlight this as our 15th year since IPO. We celebrated that recently by ringing the closing bell at the LSE after our capital markets day. We IPO'd back in 2010, and I've highlighted on this slide some of the key events during our life cycle. I think what's characterized GCP over its life is the fact that it's been an early mover into new sectors. We've not been a follower in the infrastructure space. We were one of the first subordinated debt investors in PFI PPP projects. We funded debt into some of the first UK rooftop solar and wind farms. We were one of the first investors into wastewood power stations in the UK. And I think what that's meant, and the fact that the fund, as I'll go into in a moment, has a diversified investment objective, it means we haven't lived or died by the evolution of any specific asset class. And our response to certain asset classes developing or evolving has been to target new asset classes, which has, in my view, allowed us to deliver an enhanced risk-adjusted return relative to having to continue to invest in a more mature asset class. The 7 pence per share dividend target that we maintain today was set up, established in May 2020. At that time, we gave guidance that that dividend would be paid on a stable basis over the medium term, which is absolutely what we've done. If you're an IPO investor, you will have received the aggregate of your IPO subscriptions back through dividends paid in 2024, and the total NAV return over the fund's life has been 187%. In terms of the fund objective, the headline objective of the strategy is to fund UK infrastructure. So we are a UK focused strategy. We do not have foreign currency or jurisdiction risk within the portfolio, targeting infrastructure that benefits from some form of public sector backed cash flows, with a focus in investing in the debt part of the capital structure. We are IPO back in 2010. We're a FTSE 250 constituent, market capitalization of just over 620 million, net asset value of 840 or so million, with an investment valuation of 854. The difference really is the cash and debt balance. We're not a highly geared strategy. I think debt was drawn to the tune about 14 million at the end of December. So it really, the fund level debt is a working capital facility rather than any structural gearing that we have at a fund level. The investment objectives of the strategy have been maintained entirely consistently since IPO, so these haven't changed over the last 15 years. Income has been a key reason why infrastructure as an asset class has developed in the way that it has over the life of this fund. We've paid now a consecutive, stable and sustainable dividend that's covered by income generated in the underlying portfolio for the last 15 years. We are, as I mentioned a moment ago, well diversified across a range of asset classes. The fact that we've been able to evolve the asset mix in the fund, I think, has been a key competitive strength of the company over its life so far. Because we focus on debt and because infrastructure by its nature is a defensive asset class, capital preservation is a key characteristic and objective of this strategy. And the KPI that we quote at the bottom of this slide at 0.51% is our effective loan loss ratio or loss given default ratios. If you look at the total amount we've impaired or written off divided by the total amount we've invested on an annualized basis. And that's a gross number. We haven't netted off the positive fees we've been able to generate through, say, early repayments. That's 0.51%. And that reflects really well against an equivalently returning Moody's credit instrument more broadly for an equivalent return or rating. That number should be about 2.2%, and that's been a quite widely quoted number in the papers recently around private credit defaults that we've seen more broadly. ESG wasn't an explicit objective of the fund and indeed isn't today, but infrastructure by its nature has positive environmental or social characteristics. Fundamentally, where we are today is we have a portfolio of 850 million or so, all of which has some form of positive environmental or social benefit. And this is an area we've worked really hard to try and draw out in terms of quantitative data and to have that data independently verified. And there's a huge amount more detail in the annual and interim reports on the impact of the fund. So just to recap, the objectives of GCP Infrastructure have remained consistent since day one: paying income, diversify across a range of asset classes, preserve capital. Infrastructure by its nature is defensive, and the fact we focus on debt adds to the fact that in an investment process, we're very much looking at getting our money back rather than perhaps valuing equity upsides. And then ESG is a resulting impact of the fund and the types of assets that it targets. To dive into a bit more detail on what we mean by debt and why we think that's beneficial from a risk perspective in terms of infrastructure asset classes, the chart on the left-hand side of this page really sets out the product of our due diligence process, and it's very much a simplified chart. But really, coming back to my comments earlier about infrastructure being an asset that does a job over its life, what we're looking to due diligence as part of an investment process is the comfort in those cash flows and really understand to a high level of detail what factors might influence those cash flows over its life. So really looking at the various revenues, the cost assumptions for the asset, sensitizing those and taking a conservative view as a lender, which is often very different to the view that equity investors in assets take. Once we have a view of cash flows that we're comfortable with, we're then taking a senior position in those cash flows. And as you can see from the chart, the amortization of the debt is complete over the life of the asset. So that cash flow has to service both the full repayment of capital and also the income component, very similar to, I guess, an annuity type profile. The equity is then on top of that, and to the extent those cash flows change, so if the bars on this chart go up or down at all, it's equity that will be impacted first, with the debt cash flows being preserved. In terms of the chart on the right-hand side there, we do invest in both senior debt and subordinated debt, and indeed the fund does have some more equity-like interests as well. And I guess as we move down through that seniority, we have different rights in terms of security, priority of payments, our ability to influence the borrowers and their performance through covenant triggers. The debt that GCP writes tends to be bespoke bilateral debt negotiated for the specific benefit of a project, and that debt is covenant heavy, so it contains lots of requirements both from a financial covenant perspective but also a business perspective that give us control to the extent that or escalating levels of control to the extent that certain things happen or indeed don't happen. In terms of the portfolio where it sits today, and hopefully the diversification theme comes out here. So renewables makes up just under 60% of the allocation, as you can see in the inner chart there. The outer chart shows the diversification that we have within renewables across multiple asset classes: commercial solar, biomass, rooftop solar, onshore wind, AD, and hydro. PFI PPP, so this is traditional social infrastructure that was procured under the private finance initiative. That makes up just under 30%, and these are typically assets in the healthcare, education, leisure, and waste sectors. And then supported social housing is around 15% of the fund. This is social housing that provides care as care requirement as part of the social housing provision. What we've also shown on this chart is the nature of the interest. So where there's a more equity-like interest in the assets, that's highlighted by the inner yellow segment. And also where we're currently, and I'll come on to this in a moment, looking at disposing or recycling out of assets, we can see that in the orange segment. We'll run through a couple of the statistics on the right. Portfolio is valued at 850 or so million at the end of December across 47 separate investments. The weighted average life of the portfolio is 11 years, generating around 8%. None of the portfolio has construction risk where we sit today, and that is a fairly material de-risking that's happened over the last 6 or 7 years, at which point the construction exposure was closer to 18 or 19%. So the portfolio is now diverse and operational. And to touch on the bottom one, just under 50% of the portfolio has some form of inflation protection, so a pass-through of inflation benefits in the revenues to the underlying debt structure, whether that's the indexation of the coupon payment or sharing of principal uplift to the extent of there's a higher inflation than a benchmark. We show various different cuts of the portfolio on this slide. So the income type, so what underpins the revenues for the projects that ultimately we're investing in. As you can see, the emphasis in this fund is on public sector backed cash flows. So the universe historically has really been those sectors that the UK government is seeking to support through revenue support models. And it's well diversified across a range of different support mechanisms. So we don't have particular exposure to any one mechanism. Some of you may be familiar with the recent changes that were made to the renewable obligation and feed-in tariff regimes. And whilst that did impact the company, it impacted to a lesser extent than perhaps some of the peer group in the renewables and infrastructure sector, because we're diversified across a range of different mechanisms. Perhaps the other point to draw out on this slide is the chart on the right-hand slide that shows the diversification by asset class. So the top 20 assets make up around 43% of the fund. So there's a good level of underlying asset diversification with no oversized exposure to a single asset. Indeed, the largest asset on that chart is a portfolio of over 40,000 rooftop solar installations across the country. Many of you will be familiar with the challenges that the alternative income sector broadly has faced over the last 2 to 3 years, whereby the funds have moved to having historically traded to a premium to their net asset value and moved to a discount. As Alan set out at the start for this fund, that's recently been sort of 20 to 25-ish% discount to NAV. Our response to that, and I would like to think that we were quite early with a proactive response to how we would address the discount, is to set out a capital allocation plan. So at the end of 2023, we committed to recycle on an accelerated basis around £150 million of assets. We committed to use that to pay down fund level leverage, which at the time was around 104 million. Where we sit today is materially reduced at around 20 million. And return at least 50 million of cash to shareholders by way of buybacks. And so far there's been just under 37 million pounds returned to shareholders by buybacks. I think the objectives also included to demonstrate that NAV is a more appropriate valuation point than perhaps that indicated by share price and the discount. So far, of the 130 million pounds of disposals that have been completed or announced, that has on average been at NAV, so has demonstrated the underlying valuation is relevant for those asset classes. It's also worth saying, to the point on the right-hand side, that we haven't picked the best assets or those assets that are, in our view, easiest to monetize. We've very much thought about what we want the portfolio to look like coming out of the capital allocation process. And that's been to, as per the chart on the pie, to reduce equity-like exposures, to exit supported social housing as a sector, which, whilst it's been a pretty good performing sector for the fund, does, we recognise, suffer from some wider public market perception challenges because of what's happened elsewhere. It's also the longest duration and lowest returning of our asset classes. So from a portfolio mix perspective, we think makes sense to recycle out of. So we've not only demonstrated NAV, but I would argue we've done that in some of the fund's perhaps trickier areas, which I think should promote confidence across the wider valuations in the portfolio. We do also talk quite extensively in our public market disclosure, so the annual report and interim reports, about benchmarking the valuation of assets within this fund versus other peer group funds. And because we've come at the sector from a debt perspective, we are by our nature more conservative in the types of valuation assumptions we apply, particularly on renewable assets, where we do see quite a wide range of valuations being applied, or approaches to valuation being applied across different investors. We had our Capital Markets Day late in February, and having largely delivered on the £150 million that we committed to at the end of 2023, we set out the strategy for what comes next. And the message really was that we can expect continuing recycling of capital out of perhaps the legacy portfolio. And we currently have a 200 million or so pipeline of disposals or refinances that we're actively working on for the underlying portfolio. So continuing sale of assets, continually demonstrating NAV and trading out of existing assets will be a theme, I think, regardless, moving forward. We then set out a fairly explicit framework for when we would be returning capital to investors, and we set out a range of a discount between 5 to 15%, below which we would continue to return capital to shareholders, where frankly the investment opportunity of buying back our own shares makes sense over and above new investment activity. And then within that 5 to 15 discount range, we would continue to buy back shares, but we would also review selective new investment opportunities where we think doing so is attractive relative to buying back shares, but also would have positive return and risk characteristics relative to the wider portfolio. We do recognise that scale is an important feature for many of our larger shareholders, and maintaining scale and the associated liquidity of underlying shares is important. So the headline objective of trying to maintain NAV at greater than £750 million, and also sustaining the dividend target at 7 pence per share in the medium term, are the basis on which we'll be making the investment versus buyback decisions. There's a fair amount of room there, I'd observe, between where NAV is today at 840 million or so, and that's 750 to buy back shares and return capital to shareholders, which hopefully gives us sufficient firepower to do that, and where we see that as the best investment opportunity for the use of the company's capital. So to touch on UK infrastructure, and what we've done here is show the trading 12-month yield of GCP Infrastructure on the right-hand side there versus various other asset classes. I think the characteristics of the opportunity, as I'd characterize it now, so the funds sector more broadly moving to material discounts, are driven by probably two things. The first is the rate environment and the fact that these are relatively long duration fixed rate instruments, and therefore in a higher rate environment there should be a re-rating. I think the thing that's compounded that is the fact that we've seen a flood of capital amongst the UK wealth and retail market move out of alternative income into perhaps more in favour of more traditional sources of income, so bonds or gilts or money market instruments, which really has just led to a structural lack of demand in what is frankly not the most liquid set of underlying assets. So I think for me, it's that's created the opportunity in these asset classes, the fact we can access a dividend that's been paid on a stable and sustainable basis for the last 15 years, underpinned by a diverse portfolio of operational assets at between a 9 and 10% yield, for me is attractive. So the market conditions, rate environment, and the fact that there's been a flood of capital away from the asset class and reallocated elsewhere creates the opportunity that I think we see available today. This summarizes the full journey that we've had since IPO. You can see the dividend there, which is the blue line at the top, the share price, which is the green line, and then the black line shows the NAV. And the NAV has moved about a bit, but I'd argue it really hasn't moved by very much, given some of the macro events that have punctuated the period, and particularly the last 10 years. Infrastructure has, in that sense, done what we set out it should do. It's been defensive, it's been non-correlated to broader public markets, and has benefited from the underpinning of long-term cash flows that have been locked in on day one. The dividend, as you can see, has remained stable. It was set at the 7 pence per share level in May 2020 and has remained consistent since. And the guidance that we gave at the Capital Markets Day last month was that we would seek to sustain it at that level in the medium term. And as you can see where we sit today, I think just the share price today is about a 25–26% discount to NAV. That's just over 9% implied yield on share price. I want to spend a brief moment trying to characterize GCP's offering relative to the wider peer group, and we're often put into peer groups with the renewables equity funds, but also the broader infrastructure funds. The first distinction I'd like to make is that between debt and equity, and we're obviously very aware of SECI, the other listed debt strategy. We like that strategy, we invest in it elsewhere in our business, but it does do something quite different to GCP. It tends to be shorter duration, more geographically diverse. It is, by its label, an economic infrastructure fund, and economic infrastructure does have more perhaps exposure to GDP or economic performance in terms of the revenue makeup of the underlying assets, compared with GCP, which is much more availability based. Assets will be paid on the basis of whether they're available for use, regardless of how much they're used. It's a UK focused strategy, longer duration strategy. I'd also argue it has more debt, where that debt has been written on a bilateral basis on a bespoke set of terms for a specific project. In terms of the wider market, the distinction perhaps I'd like to make here is between the infrastructure equity peer group and perhaps a more of a private equity style risk. And all of these are observations of difference, perhaps, rather than coming across as saying something is good versus bad. I'd come back to an infrastructure risk as being an asset that does a job over its life, and our job as investors is to assess the cash flows generated by the asset over its life. That is a very different set of considerations to investing in a corporate that has a business strategy that might have a capital intensive infrastructure base, but has a regulated business, a non-regulated business. It has employees, it has pension liabilities, it has a business strategy that perhaps spans multiple geographies. It's underpinned by a management team and reliance on people, versus that asset that does its job over its life, where the services required by that asset are contracted out to third parties. So I think as we see some other funds take on more development exposure or go into more early stage risk in projects where they're really backing people to go out and get quick connections or planning consents in new geographies, perhaps that for me is more of a private equity style risk than it is a pure infrastructure risk. And we need to be conscious, I think, of those differences in risk. 3i Infra, I guess, is the extreme example here, which has performed really well for its investors, but does explicitly target infrastructure related services, so the businesses that support infrastructure rather than the underlying assets itself. So there is a spectrum of risk that labels itself as infrastructure, and I do think investors need to appreciate that. My final observation on this slide would be that GCP infrastructure does occupy a white space in what is elsewhere a relatively congested landscape. So if we're looking for long justification for longevity of this fund, we do think it provides investors with something that they can't access elsewhere, both differentiated from the other pure play debt strategy, but also the broader infrastructure equity and more peer group within infrastructure. So to try and draw the presentation to a close, we do think now is an attractive entry point driven by those market dynamics, the change in rate environment being, I guess, a direct impact, but the additional impact that's been had by just excess of share supply as investors have moved elsewhere into other asset classes, not because of underperformance of the underlying assets, certainly in GCP's case, but because of just decisions to reallocate. So we do think now's an attractive entry point. That 26% discount is I think just less than a 10% yield on share price. The fact that that comes from a portfolio that is well diversified across a range of different asset classes and is fully operational, so no construction risk in the underlying portfolio. Infrastructure does provide a set of defensive characteristics that I think are going to be increasingly valuable in what is and what remains a volatile world. I think concerns over AI, I think energy security is been front and center in the news. Infrastructure has a key role in terms of both delivering AI, delivering energy security, but is also defensive against some of the risks that those things present. The fact it's underpinned by real assets, limited obsolescence risk, as I started off by saying. We do think now's an exciting time to be investing in infrastructure, particularly in the UK. The government has announced a series of support mechanisms in sectors that we know well, the Contract for Difference supporting traditional renewable technologies, but also extensions of that to sectors like hydrogen, carbon capture, sustainable aviation fuel, as we look to support our energy security and bring energy generation back home, but also progress with the decarbonisation objectives that we have. And perhaps if I was sitting here 2 weeks ago, I'd have been perhaps more bullish on this than I can be today. But with rates coming, or the prospect of rates coming down, and perhaps looking further forward, more stability, we are having more discussions with investors about the benefits of infrastructure and the income generated by infrastructure, which on a relative basis will continue to look more attractive as the wider rate environment comes down. Perhaps I'll stop there, Alan, and happy to take any questions.
Yeah, thanks, Phil. And I really like these questions that get to the kind of heart of things. And one of the first questions that came up was exactly about what you were just talking about, interest rate sensitivity. And I think whilst it's fair to say your share price and perhaps even the valuation of your underlying assets is interest rate sensitive by its nature, it's a little bit more complicated than that, isn't it? Because you're not investing in straightforward bond-like instruments. So do you just want to talk a bit about how the interest rates interact with your valuation? Obviously, you have amortizing loans and you have inflation links and even some equity characteristics in some cases. You just want to. I know it's a complicated subject, but it's not straightforward, is it, to say you're interest rate sensitive?
No, I mean, I think that there is the headline point, which I think I can't get away from, is this is a relatively long duration income instrument, and therefore there will be a sensitivity to interest rates on a relative basis. It does look less attractive in a higher rate environment. And the underlying assets are long-term assets, so it's a little bit like a super tanker. We can't just change that overnight and point it in a different direction in response to a volatile rate environment. So that's probably the headline point. I think the kind of counters to that are that we do have 50% of the portfolio with some level of inflation protection. So we have over the last 3 or 4 years seen, and this is accrued to NAV rather than perhaps a change to dividend, but more income generated by the underlying loan portfolio because of high levels of inflation. So there's a natural hedge there, which in turn is, and that's not a comment on credit quality, because that's matched by changes to the cash flows generated by the underlying assets, and the fact that they're inflation linked themselves allows us to put those inflation linked debt instruments in place. So there's no impairment of credit, as we've perhaps seen in other sectors where higher inflation means that there's higher debt service obligations which aren't matched by increased cash flow generation by underlying companies. I think the only other sort of perhaps comment I'd make is, if what's driving concerns at the moment is uncertainty, then I think people coming back to non-correlated defensive nature of infrastructure is potentially valuable as well. And I think looking at what's happened in the last week or so, there's very little that hasn't been impacted by the events in the Middle East. So I would argue that infrastructure and infrastructure debt, particularly focused on a geography like the UK, should be a relative haven in a storm. And in terms of the impacts to the cash flows or the business models of what we ultimately invest in uncertain times, I think that argument is strengthened. We do elsewhere, and I think as part of the Capital Markets Day presentation that is available on the company's website, present the interest rate durational sensitivity and break that down by the various asset classes. I think the comment that comes through in that is the fact that supported social housing does have a very long duration and therefore does increase the sensitivity that we have to interest rates. We are looking to trade out of that, and therefore, as the capital allocation program progresses, the interest rate sensitivity on a direct basis will reduce over time.
Mm-hmm. Thanks, Phil. There's a question, and the questioner is apologising for being a new investor. That's what we're here for, so no reason to apologise. But their question is, you talked about this. There's some inflation links and reasons for the income on some of your loans to grow. So why is the dividend fixed? And it has been for several years, hasn't it? And why isn't it increasing with inflation?
I think it's a good question, and certainly one we've been asked before. We have set out to pay a stable dividend, and so any sort of benefits in terms of additional income generated by the portfolio will accrue to NAV rather than dividend. This is something we'll absolutely keep under review. To the extent we can pay out more income, we absolutely will. But 50% of the portfolio is fixed rate long-term debt, and so we also have to be mindful of that. So and this will come through in the dividend coverage analysis that we present every 6 months, but we do, as a fund, aim to pay out all our income by way of dividend. So when we look at dividend coverage, it's largely 1 times covered, but that's sort of appropriate in my view for a fund that is trying to maximize income to its investors. So that will continue, and to the extent income does increase because of inflation dynamics or elsewhere, then ultimately investors will receive the benefit of that. But where we are today, the guidance is that the dividend will be stable at 7 pence per share.
Okay, and just continuing on the income side of things, there's a question about rolled up interest, which many people watching this may not know is fairly common practice in your world, isn't it? Do you want to talk a bit about how rolling up interest works and how you account for it, and how that to what extent the dividend is paid through rolled up interest?
Certainly. So yeah, effectively rolling up interest is where interest due, which is percentage on principal balance, can't be serviced with cash, so we effectively lend more money to pay interest. And I completely understand why that is a potential red flag for investors, and indeed it should be. I think the response to that is we've been very transparent about where this comes from and why it happens. And a large part of our rolled up interest is designed by its nature as part of the investment case to occur. So particularly where we have sub-debt investments in PFI, where PFI concession might be, say, 25 years, where the first 15 to 20 years of that, the majority of the cash flows are taken up with senior debt service. So effectively what's happening there is we're sweeping the cash flows that are available post senior debt service. To the extent the interest isn't being fully serviced by those cash flows, it's being rolled up. So the return is being preserved. We're effectively making an investment back into that project, and then that is being serviced at the back end once senior debt has been fully amortized and there's a bulk of cash flows in, say, years 15 to 25 or 20 to 25 that there's no other call on, and senior debt has fully amortized. So there's a large component of it, and we do differentiate between what's budgeted and what's not budgeted in the disclosures. That is part of the business plan and part of the business case. And indeed, in those cases where there's been a period of higher inflation, the underlying cash flow generated by the project is higher, and therefore the amortization is effectively pulled forward because cash flow generation is higher. So so we do disclose this, and we try and be as transparent as we can about why it's happening. There is a component that is unscheduled and where something's gone wrong at an underlying project, and for whatever reason debt service has been delayed or payment hasn't occurred. And there's part of this, and this is also comes through in the disclosure, where let's say interest is due on the 30th of June, and for whatever reason it's not paid for a week or two, and often that's administrative, as perhaps you're getting a senior lender consent to pay a subordinated lender, or you're moving cash up through a corporate structure. We do automatically capitalize the interest that was due on that day, just to preserve return. So rather than extending a free loan for 2 weeks while whatever administrative issue occurs, we are rolling up that interest into principal. There's a return accruing on that principal, so the underlying return on the debt is preserved, and that happens automatically under the loan documents and indeed our systems, and then comes through as when that cash flow ultimately comes through is seen as a principal rather than an interest payment. So we do again back that out of the calculations and try to be transparent about that. But look, if any investor would like more detail on this, we're very happy to provide it. I should add that we do have an online portal. We're, I think, the first investment company to publish an online portal that gives investors the ability to go into the portfolio and really drill down into each investment and each asset and see underlying asset performance. And we've made a real drive to be transparent and improve our disclosure over the last 7 or 8 years. And any investor that would like access to that, please do get in touch with us, and we'll be very happy to provide that that access.
And just talking about the different holdings, that there are a few different questions that kind of have specific reference to sectors you invest in. So do you want to just bring to life, I mean, there's a question about biomass and anaerobic digestion specifically, but do you want to talk about 1 or 2 of your assets? You know, from a credit investor, how you look at them when you first lend to them, and how you can how you monitor and improve those assets over time. And there is an example with a video we shot last year, and perhaps that might be a useful one to pick, but you don't have to pick that one if something else springs to mind.
Yeah, thanks. I mean, I'm very happy to pick Birmingham Biopower. So this is a wastewood biomass project that we have in Birmingham. It's about 10 megawatts electrical capacity. It's a relatively small project, but takes about 70,000 tons of waste wood each year, burns that to produce electricity, which is exported to the grid. That waste wood comes from the construction and demolition industry, so housing refurbishments, office refurbishments generate wood, and that wood, rather than being sent to landfill, which is hugely damaging to the environment, is collected and is streamed off and is sent to facilities like the one in Birmingham to be burnt and to generate electricity. So we originally invested in that project, I think, back in 2013 time. We were a senior lender alongside the UK Green Investment Bank. So the senior lenders provided about 50% of the overall construction costs. So we were 25% of the overall cap stack, and the GIB were the other 25%, and then equity was the other 50%. A series of different equity investors that came on board, including Balfour Beatty, who kind of led the development and an equity consortium. The project went through construction. It commissioned, and ultimately, debt was serviced for a number of years, a point I'll come back to. In terms of how we looked at that investment, I guess 50% loan to cost has some embedded capital structure protection in the first instance, but we took a fairly conservative view on long-term power prices. That project benefits from renewable obligation certificates. It gets 1.9 ROCs per megawatt hour that it generates to the grid. So about 60 to 65% of its revenues come from an inflation-linked government-backed support mechanism, the remainder being merchant power prices and some other other income such as embedded benefits that you get from being connected to the distribution grid rather than the transmission grid. So we took a fairly conservative view of long-term power prices, certainly more conservative than the equity participants. The other kind of key metric is the availability, so the number of hours in the year that the project will be generating at its full load. And I think whilst equity investors would typically assume a 90% type level for that project, we took I think a 75% or so availability assumption, assuming that there'd be more maintenance work or more downtime, which is exactly in actual fact what's happened. I think because of that factor, the project was under some stress. I don't think it was performing in the way that equity investors wanted it to, notwithstanding that debt was being serviced post completion of construction. There were a series of works that we as lenders thought needed to be done to the project, so additional capital that needed to be invested, particularly around the fuel handling system. So if I getting the waste wood from the fuel hall to the boiler or the combustion system, which equity, for various reasons, wasn't willing to do. We ended up stepping into the project, investing that additional capital, and taking control of the project. And it's had its best period of performance since we did that in early 2020, where shortly we'll be going through a process of disposing of that interest, having stepped in, invested, turned it around, we've replaced the operator, replaced the PPA, replaced the management service provider, invested some additional capex into the business. And I guess both, Gravis's business spans both debt, and we also have an equity business that invests in these types of projects from an equity perspective. So we don't have a concern about an ability to get involved in the assets and take them on and manage them where we think that's going to be in the best interests of ultimately our recovery or our lenders. This asset has about 10 years of ROCs and subsidy left. It's operating at the level that we assume in the long-term model. And I think actually the exciting thing about that asset now is it is a fairly critical sink of waste wood in that part of the world, in the Midlands. And I think there'll be longevity beyond the 20-year point that we assume currently in our valuation. So from a sort of equity perspective, we now have access to that value as potential upside that we should try and crystallize for the benefit of GCP investors. So that's not been I highlight that, I guess, because it's not been a case that's necessarily gone completely to plan, but ultimately shows what we can and have the ability to do as lenders to protect value, and we have protect value in that project. And actually, the fact that we now have some, I think, relatively exciting opportunities as a result of that. There's lots in the portfolio that's much more boring than that. So the PFI, PPP, the solar and the wind assets largely sit there and do exactly what they're meant to do. And whilst we monitor that on a regular basis, and we have a team of people here, both on the equity side and debt side, that do monitor that, and you'll see that data coming through in terms of the KPIs that we present in the investor portal, and that's only a subset of the monitoring that we do. But yeah, I highlight that because it's probably been a more active asset over the last 10 years or so.
Yeah, and as I said, that you can watch a little infomercial on the asset on probably on your website as well, but certainly on our website. I know we had a little technical hiccup in the middle, so we probably got time for one more question. And I mentioned at the top your 26% discount, and there is a question on how the NAV is calculated, and I think it would be good just to understand the kind of main inputs to that, maybe a quick summary rather than the accountant's view, and then there's a few other questions, and particularly there's a question about buybacks that I'd like to get that viewer an answer to. But if you can email us, we can get you an answer to that later. So if we could just wrap up on just describe how the NAV is calculated and the kind of level of confidence that investors can have in that.
Sure. So ultimately the NAV is a function of a discounted cash flow for each underlying asset at a discount rate. And I guess therefore there's the two inputs into that. What are the assumptions in the discounted cash flow, and what is the discount rate? The discount rates are set by Mazars, and there's they spoke at our recent Capital Markets Day. Ben Morris, the partner there, goes through the answer to this question, I think, in quite a lot of detail, and that's a video available on our website as well. But ultimately, what they're doing is they're looking at what is the risk in the underlying cash flows, how aggressive has GCP been in terms of its assumptions in the underlying models. And I think generally we are not very aggressive. We're quite conservative in which power curve we use, what asset life assumptions we use, what long-term inflation assumption we use. And then what they're really doing is trying to calibrate the discount rate in light of the market benchmarks that they see for that asset class, given the nature of those assumptions. So there's an independent view, first and foremost. This isn't Gravis sort of marking its own homework. Mazars are an independent advisor to the board and advising on discount rates. Probably the second check and balance investors should take confidence from is that KPMG's valuation team do review Mazars' work on a 6-monthly basis, part of their interim review, but also the annual results. So, and there's a fairly detailed dialogue that goes on a quarterly basis between us and Mazars, but then on a 6-monthly basis between Mazars and KPMG, where at all stages we're having to debate and justify the underlying valuations and test those with what benchmarks we've seen in the markets more broadly. So ultimately you're setting a discount rate. That discount rate is embedded in ultimately the risks that we see and others see in a set of cash flows that are being discounted, which is obviously a very asset specific set of considerations. Also, the final thing I'll say on this, to the extent that there are asset specific issues or considerations, so for example, we have a wind farm in Northern Ireland that's suffered quite a high level of curtailment and constraint, so effectively where the grid has told us we need to switch off because the grid can't take the power. So there's some asset specific considerations there that either will be reflected through a change in discount rate or through a change to the underlying cash flows that we're assuming by modeling a curtailment or assumed constraint level. So hopefully that gives a bit of a summary. I'd encourage anyone to look at Ben's presentation as part of the Capital Markets Day that goes into more detail on the work that Mazars do independently from Gravis to support this.
And that's a technique that's very widely used, and similar techniques are applied in commercial property. So this is a very, very standard kind of process, isn't it?
It is, absolutely. And I think my comment would be, and this isn't intended to come across as perhaps critical, but I do think that there is a fairly wide difference in assumptions driving a cash flow that's being discounted, particularly if we look at renewables assets. And I think that's an area, certainly if I was put myself in a shareholder's shoes, I'd really want to understand. And the fact that there's about a 20 megawatt per hour real-term difference between the highest and lowest power curve provider out there is a massive difference in nominal cash flows that are then being discounted to get to evaluation. So it's really, I think the work really should be focused on, well, what's being assumed in the cash flows and what level of risk does that present? And you'd like to think it's always reflected in differences to discount rate, but I think in reality across the market it probably isn't.
Okay, I think that's a good place to wrap up. Thanks for everyone sticking with us through our little technical glitch in the middle, which we'll edit out in the rewatch. Phil, thanks to you for your very thorough presentation. As I said, I know there's a couple of questions we haven't had time to answer. Please do get in touch if you'd like us to get back to you. I say this every time. The manager's website is always a useful place to go for further information. I think whilst every investment trust we work with has an excellent website, GCP's website is particularly excellent. So please do visit that for more answers. And of course, you can always come to Kepler as well. Thanks to everybody for attending, and thanks to you, Phil. And we'll see you on the next one next week.